thank you, Cryptio, for pulling together such an incredible group of individuals who are helping to shape the digital asset ecosystem, an industry we're all proud of to be part of. My name is Cheryl Lesnik, and I'm a partner at PwC. I started my career in traditional asset management and banking capital markets before moving over exclusively to the digital asset ecosystem in 2021. I am PwC's digital asset growth and strategy leader, where we are proud to serve top-tier traditional and native players in the space. And now with me today, I have an incredibly impressive group of panelists, each an expert in crypto lending, who might have had a little more sleep this weekend than last. I will let these gentlemen introduce themselves. Max, you could start.
Max Bareiss, head of lending at Galaxy Digital.
Dhruv Patel, co-founder and CEO of Arch Lending.
Matt DeCicco, head of digital assets for global markets at Cantor Fitzgerald.
Justin Davda, institutional product at Coinbase.
Awesome. I thought you guys were going to do a little longer intros, but we're good. So crypto lending is a $60 to $80 billion market today, still tiny compared to trillions in traditional credit. What are your companies building to scale this into $500 billion institutional asset class, and where are you seeing real traction? So Matt, let me start with you.
Sure.
I'll intro you to that, okay? So Cantor launched a $2 billion Bitcoin-backed credit facility earlier this year with early development through platforms like FalconX and Maple. How are you deciding when and where to deploy more of that capital, and what signals give you confidence that institutional crypto credit is ready to scale?
Sure. Yes, as mentioned, we've been live lending exclusively against Bitcoin for the last 6 months or so. To this point, like we've been onboarding a broad range of borrowers across the ecosystem, both on the institutional side and kind of crypto native. I think we're at the early stages, kind of the precipice of broader institutional comfort with lending. So what we've set out to do is really build a product that looks and feels like kind of a traditional borrower lending structure in traditional finance, with Cantor looking to be kind of the institutional lender of choice within the digital assets ecosystem. So I think there's still a fair bit of work that needs to be done to get more traditional pools of capital comfortable with lending against digital assets, which is why we've intentionally built a product that is really exclusive to Bitcoin right now. We are seeing interest for borrows against other tokens. I think there's where we think Cantor can add a ton of value is kind of the brand and the reputation and kind of the risk you take in borrowing from an institution like ourselves. Obviously, I think it's incredibly constructive to see the way the ecosystem has continued to evolve. But I really think the major unlock from kind of a scale perspective is going to be, it's an iterative process of getting kind of institutional pools of capital more and more comfortable with lending against different assets. And I think it has to start really with Bitcoin before you see kind of the ecosystem, the lending market grow at scale.
Thanks, Matt. Justin, you're up. After the post-2022 collapse in the industry and the SEC targeting Coinbase Borrow in 2023, Coinbase rebuilt its institutional lending program around fully secured, transparent loans through prime custody. Where is demand strongest now? Short-term USDC liquidity, longer-term BTC, ETH, backed credit, something else? And how have you strengthened risk controls and disclosures to restore institutional confidence?
So I actually think I'd push back a little bit on the premise of the question, Cheryl. Coinbase has actually been active in institutional lending since 2019 on an uninterrupted basis, when we started lending against what was then our Coinbase Pro platform, is now Coinbase Exchange, where we provide DMA services to market makers. I think you might have been alluding to our sort of retail product, which, as many of the room will be aware, attracted a lot of sort of regulatory pushback in the sort of Gensler SEC era, and we subsequently deprecated because it was clear there wasn't a path at the time for a compliant way to serve the U.S. market, and compliance is one of Coinbase's hallmarks. But conversely, on the institutional side, which I think is what we're talking about, we've really been continually building and continually serving clients for 6 years now, which in crypto is an awful lot of credit and market cycles since we work in something like dog years. And as you will have seen in our, since we're a public company, we report our loans outstanding at the end of every quarter. And as of the last quarter, we're well over $1 billion in loans outstanding to really every customer segment in the space, whether it's market makers, VCs, corporates, hedge funds, asset managers, high net worths. We sort of have developed a product set to serve all of those customers on their unique user journeys. And I look forward to talking a little bit more about that today.
Awesome. Thank you. Max, you're up. Galaxy runs one of the most established institutional credit desks in crypto, balancing bilateral OTC lending with selective on-chain activity. You're now launching on-chain Prime to route collateral across venues and use DeFi as a bridge for short-term liquidity gaps. Where are you seeing the next wave of demand, and how are you deciding which exposures belong in traditional credit structures versus new on-chain markets?
Yeah, so I guess just to explain the program in a little bit more detail, one of the things that we're developing and we're sort of seeing is that a lot of our counterparties are referencing DeFi rates in terms of where they're seeing the market, in terms of the demand to borrow, and we're sort of meeting the customers where they are. What we do really well is we have the ability to run a 24/7 operational lending business, and we can take counterparties Bitcoin, Ethereum, Solana, and use it in a way where creating that collateral pool, we're sort of agnostic between the different collateral, just different haircuts depending on the asset type. We have the operational process to take the Bitcoin, go somewhere like a Coinbase, wrap the Bitcoin, and put it on chain. And for a number of traditional financial institutions coming into the lending market, they don't have that operational know-how to do something like that. And then in addition to that, they can't manage for auto liquidations, which is definitely something that's very prevalent in on-chain markets. And with that, we're basically able to back-to-back and pass through the DeFi rates. And what's even better is sometimes we don't even need to do that. If we're sitting on excess capital, we can use that as a treasury management solution, and it's allowing us to have some of the most competitive rates across the ecosystem. I think there was a second part to that, which is how we...
Where are you seeing the next wave of demand? But you might have already touched that.
Okay.
Yeah. And how are you deciding which exposures belong in traditional credit structures versus new on-chain?
Got it. And so when we look at on-chain versus traditional credit, I think there's obviously different risks that are associated between the two. You have counterparty risk in traditional. Oftentimes we try and push for tri-party. In terms of on-chain risk, you got to think about that because there's no tri-party. You have smart contract risk, you have Oracle risk, you have things of that nature. So limiting what you have in terms of on-chain exposure is important. And so there's a number of different ways that we've tried to mitigate that through structuring in terms of creating a new prime entity. That prime entity has $100 million of first loss capital. We take a borrow from our central treasury, but make sure that we don't blow up the entire business if something like Aave, Morpho, Camino go down, and all the capital's then there at risk.
Dhruv, ARC is redefining lending beyond standard crypto-backed loans with its perpetual income BTC credit lines, where clients borrow progressively against appreciating assets without selling them. What led you to focus on this innovative product, and any ideas for other similar products in the future? You don't have to tell us.
Yeah, definitely. So maybe I'll just start with our primary audience is high net worth individuals, but we also service retail more broadly and institutions. For us, what we saw was we have a fully automated crypto-backed platform broadly, but we then developed niche tailored products on top of that. So the perpetual income product is focused towards a crowd that is retired or may not have a traditional W-2. And we have a conservative loan to value against Bitcoin, that automatically increases every year so that the client can get the same amount of cash flow to them, assuming certain price appreciation of Bitcoin. Now, other products that we're developing, we're actually announcing another one this week, is geared towards high income earners, where they can use the loan and invest it in certain qualifying investments that can allow them to then deduct that against their taxable income. And we'll continue to launch more tailored use case specific lending products for our clients.
Thank you. Okay. Max, you had mentioned meet the customers where they are. So as we're seeing and hearing now, the crypto lending space is moving fast and picking up steam. Now let's dive into who's actually borrowing today and how is that changing as institutions step in and collateral is evolving from crypto assets towards treasuries, tokenized funds, and even private credit. Matt, I'll start with you. Cantor has made available billions into Bitcoin-backed lending. Who are your main borrowers and what's driving their demand? Trading firms, miners, fund leverage, any appetite to move beyond BTC-backed lending? You might have touched a little bit about that before.
A little bit. Short answer is not currently, but in the future, as we continue to gain scale and broader adoption of our lending product, would love to expand to other tokens, but no plans at the current time. I touched a little bit on it previously, but we've seen a very broad range of kind of interested borrowers, whether that's exchanges, market makers, high net worth individuals, other lending platforms or protocols that are looking for capital. I think the biggest use case for what we are offering right now is probably, liquidity provision, whether they're market makers, exchanges that are looking for sources of funding similar to kind of the traditional capital markets, and want an institutional borrower on the other side like Cantor. I think there's probably on this stage alone, there's a very broad range of kind of, ways that we're lending across the ecosystem, with Cantor's obviously being, we're not on DeFi yet, very much kind of traditional repo style product that resonates with your more traditional institutions that, again, are looking for, sources of funding similar to what the existing capital markets, how they currently are functioning.
Max, as borrower profiles diversify, how are you deciding how much to lend against different types of collateral, crypto, stable coins, or tokenized assets? And how do you keep credit discipline consistent across them? Any hard guardrails that you are using?
Yeah, so we actually have this in our S4. I believe the S4 says that we don't lend more than 10% against a crypto collateral based on average daily trading volume. I guess just to illustrate that, if a token, let's say it's like the 30th ranked token, is trading at $100 million, that means that we're not taking more than 10 million of that as collateral, but it allows for us to have sort of a wider, range of different things that we would take. That is also limited to exchanges that we're currently trading on. So if it's trading on an exchange that we don't have any connectivity to, we sort of take that out and really just look at the major exchanges so that we know that we have the ability to get out of the collateral without creating too much slippage. To take that one step further, $10 million of collateral doesn't take into consideration the LTV. And so we're then running 24-hour look-back periods dating back to March of 2020, which is generally the date we use as sort of like the worst date in crypto, which was the COVID drawdown. That helps us establish our LTV. And so if something is 30th down the list, it's probably a little bit more volatile than something like a Bitcoin or Ethereum. Let's say that gets a 40 LTV. That means $10 million of collateral. We can only lend $4 million against that asset.
Justin, Coinbase's lending through prime custody is still anchored in crypto collateral like Bitcoin and Ethereum. But are you seeing clients starting to ask about pledging non-crypto assets, such as tokenized treasuries or funds? What guardrails or conditions would you need in place before that becomes mainstream?
Starting to, a little yes, but it's, I think, really not where the center of gravity is just yet. I mean, just to put it in numbers, I think that the entire universe of tokenized treasuries now is probably sub $10 billion. We should put that in context of the $3.5 trillion of total crypto market cap. Coinbase institutional supports 85 collateral assets, so we'll allow you to use 85. We'll lend you 85. You can short them. You can margin them on a spot basis. And that's sort of currently, and every plus one to everything Max just said about the importance of being selective and how you structure collateral. And I think we've seen time and time and again people making missteps sort of there, particularly in the crypto space. Just as an aside, it's interesting. I always think that digital assets is such an innovative space, but the sensible business practices in lending is are completely tried and trusted. Like, we're not learning new lessons here. We're applying. I think many of us come from backgrounds where we've been doing this in other sort of asset classes for a long time. And I think one of the reasons maybe the four of us are on the stage and not other logos that you could have had up here, because sometimes people forget those lessons. And certainly that's one of the things that has allowed Coinbase to be in this space since 2019. Many of our risk team come from large investment banks and have 20, 25 years of experience really in sort of lending. But so going back to your question, in the spirit of sort of meeting our customers where they are, right now customers are mostly interested in borrowing against crypto collateral. We do see the glimmers of interest against sort of tokenized assets or even other traditional assets and tri-party arrangements, and there's a little bit of that going on. But I think you guys kind of know the numbers. I think there's $80 billion or so of TVL in DeFi protocols right now, probably in the low tens of billions of dollars in centralized lending from firms like ours and so on. So versus the context of that $3 trillion of maybe good collateral, potentially good collateral crypto, the upside is the potential demand out there is so huge, and even after the tremendous growth we've seen in the last 12 months of tokenized real world assets, it's still quite a niche collateral source at the moment.
Awesome. Agreed. Traditional backgrounds, I think, do change the thought process on the makeup of the teams that are serving this industry. Coinbase, Dhruv, this one's for you. ARC's perpetual income Bitcoin credit lines presumably attract long-term holders who want tax-efficient liquidity without selling their Bitcoin. Who's using these facilities in practice? Individuals, funds, companies? How are you, and what are your standard crypto-backed loans?
Yeah, so I think for us, the primary use case for the perpetual income product is high net worth individuals across the US. But broadly, for our crypto-backed loans, alongside high net worth individuals, retail, and then we've seen a lot of businesses that people own, whether it's irrigation companies, toy companies, miners that have Bitcoin on their balance sheet, and they're borrowing against it to either expand their business. These are bootstrap companies, so they're borrowing for either growth, expansion, or sometimes to cover expenses because the cyclicality of their businesses. So we see these companies and individuals throughout the US and even internationally, but those are the borrower types.
Okay. So next, having explored the evolving borrower landscape and shifting collateral preferences, let's move into risk and return. While crypto lending rates have decreased significantly since 2021, they continue to remain several percentages higher than those in traditional credit markets. How long do you think it would take for crypto lending rates to approach TradFi levels? What do you think needs to happen for that to occur? Max, I'll start with you. Galaxy sits closest to the trading flows. Where do you see fair risk premiums versus comparable TradFi collateral? And how is the rise of spot Bitcoin, Ethereum as collateral changing the equation? How do you weigh yield versus liquidity when deploying capital today?
It's an interesting question. I think you're already starting to see the compression. I would say for it to be fully closed, probably between 2 and 5 years. I think there's a decent amount of arbitrage that's already starting to exist between the ETF and Bitcoin native. There's a number of banks coming into the space, traditional financial institutions. Cantor's a pretty good example of that are starting to do Bitcoin native. I think what they lack, or maybe not lack, but what they need to do in order to get up to speed is set up a 24/7 operational process, which is not an easy thing to do, and make sure that you have the ability to move on the collateral, whether it's nights, weekends, holidays. I think what we've seen over the last, ever since we've been doing crypto lending, is the time when margin calls hit is time of low liquidity, which happens to be Fridays, Saturdays, Sundays, holidays.
Last weekend,
yeah, it was at 5:30, and then you were up all night. And the interesting thing about Bitcoin is that you're able to move on the collateral at any time. And so you need to make sure that you have that operational team ready to go. And because of that, I think that they need to scale up the team, which means understanding whether they want to get into it or if they want to stick to something like the ETF. And if you stick to something like the ETF, you need to know that there could be the gaps that happen along the weekends, and you're not going to be able to margin call somebody until Monday, which means you got to set your LTV instead of call it like a 60 LTV, you're going to be more conservative, 50, 45. And because of that, less competitive to people that have the Bitcoin native capabilities. And so there's potential partnerships and things like that where a crypto native company could work with a bank and sort of do lending as a service in a way where they actually do the operational process and get paid to do something like that. And as that starts to integrate, I think that you're going to start to see the lending rates sort of get closer together between native and then also the ETF. I'll just say one last thing is that the ETFs are generally trading, towards GC rates on some of the different prime brokerages, just with different haircuts. But you're seeing the overnight DeFi rates on something like Aave or Morpho that are actually trading pretty comparable to what you're seeing in terms of like SOFR, and it's SOFR plus only less than 100 bips.
So you're saying Matt needs to work more?
Yes, no,
Thank you, guys.
not at all. Partner.
How do you think about, so Matt, since we're picking on you, how do you think about rate discovery and credit spreads in Bitcoin-backed lending? What's the floor once regulatory and balance sheet risk normalize?
I think we're still a little ways away from a floor looking something like SOFR, for example. I think one of the big unlocks will be, pardon to my crypto native custodian friends here, but I think as you see more and more of the traditional custodians breach into the space, and Max is completely spot on. We have challenges like this at Cantor, right? Like there is a lot of infrastructure and plumbing and staffing that needs to go into, taking a traditional 5 days a week financial institution and having it be fully supportive and integrated with the crypto ecosystem. I think as I was mentioning, I think as some of these more traditional FDIC insured custodians start supporting custody for digital assets, I think that's going to be, you're going to see more and more adoption and comfort from a mainstream perspective as digital assets and maybe not the $100 million market cap altcoin, right? But I think interchangeability of your top 10, 15, 20 tokens with kind of the more real world traditional markets that TradFi is used to. I think usage of digital assets as collateral against traditional assets, and this is where more and more regulatory clarity will be crucial, and I think we're at the early stages of starting to receive that from Washington. Will also be that interchangeability of Bitcoin versus my treasuries or equities or whatever it is, really creating a holistic prime solution for at traditional institutions. I think is going to be a meaningful unlock that will create kind of competitive, competitive lending rates for the digital assets ecosystem relative to kind of rates that we're used to on the traditional markets.
Justin, Coinbase's model emphasizes full collateral segregation and daily visibility. Has that transparency begun to narrow credit spreads for institutional borrowers, or is pricing still dominated by perceived regulatory risk?
I want to start by answering your kind of intro question about where we think rates are heading. Because I might have a sort of slight different view. I think broadly aligned with these guys that the trend will continue to come in. Personally, my mental model is I think debit rates, lending rates for large cap stablecoins or dollars probably end up somewhere around the kind of where we see emerging market equities trade now. For similar reasons, there's some access. It's a little bit more complicated. I don't think we will see large cap crypto get to the SOFR plus 20 range that large cap equities might, except in the sort of very long run. But there's definitely room to sort of come in. Conversely, though, on the short side, interestingly, Bitcoin borrowing rates are extremely cheap already. Quite, and I think we'll see more and more assets as they become closer to this sort of GC level to sort of borrow, and that's really just a function of just the amount of sort of Bitcoin available in the system versus I think the sort of amount of dollars, but definitely room for sort of compression there. And your question was the second part of the question. Sorry, Cheryl.
No, you're okay. Has the transparency begun to narrow credit spreads for institutional borrowers, or is the pricing still dominated by perceived regulatory risk?
I don't think it's a sort of regulatory risk. We talked a little bit about classic sort of risk management and credit due diligence process a little bit, but from Coinbase, I was a trader for sort of 20 years, and my mindset is that at some point there's a sort of price for everything, but we tend to, at Coinbase, we're a little bit more selective than that, and we really only focus on the most high quality sort of borrowers. So I think the start of the process is client selection, working with the highest quality borrowers, going through an extensive credit underwriting and due diligence process, and then right-sizing risk limits. And then Max touched upon about this, but one of the features that places like Coinbase can do that can straddle the world of crypto and the world of traditional finance and banking is sort of serve as a bridge between the two. While we offer loans where we'll send you an instant margin call and maybe liquidate in the middle of the night, and that can that level of risk management can be useful in some cases. One of the key functions we'll do is actually for if you're a credit quality, high quality borrower, is we will send you a margin call on a business day only and allow you 12 hours to sort of finish it, and so really bridge between the 24/7 crypto markets and the maybe the more traditional operational cadences of many of our clients. So it's sort of a spectrum, I think, between what ultimately determines rates. There is a supply and demand element, of course, and we're blessed with, I think, maybe the largest balance sheet in the crypto space right now to facilitate that. Certainly the largest regulated balance sheet. I'm counting you as only half in for this purposes, because clearly Cantor's a very large firm. So a spectrum, based on the credit quality, the types of collateral posted, the terms of the loan. It's different if someone's looking for a 1 year locked rate versus more traditional sort of overnight lending, and all of that goes into the mix to determine the rates. But bottom line, yes, rates will have come in a lot over the last couple of years and will continue to do so. And probably EM equities is where we end up, I think.
Awesome. Dhruv. Perpetual income credit lines are designed to grow as Bitcoin appreciates, but that also makes pricing and risk calibration tricky. How do you determine fair loan-to-value ratios and interest rates for such dynamic products? What safeguards ensure they remain sustainable through market volatility? And how do you communicate the risks to borrowers and investors? I
Yeah.
can help you if all three of those were hard to.
No, I can take the first part of it and then leave the rates for the second half. But essentially, the way we work is we encourage lower loan to values for those longer term borrows so that people have enough leeway to be able to continue to upsize their loans. But borrowers can also at any point add additional Bitcoin collateral to continue to access more credit. And so we have an educational component where there's recommendations that we have, but at the end of the day, the borrower is free to do as they please. With respect to rates, I think here we work very closely with Galaxy, and we've raised a CLO facility to fund our loans. And part of what we are doing is actually talking to many of the largest capital pools out there, whether it's traditional banks, insurance pockets, to participate in this structure, which is something they know and are familiar with. And that can now start to bring our cost of capital down, which allows us to lower rates in general. And so I think that will be a big unlock, just as these larger like bank-like pools of capital where their costs are materially lower start to participate here. It will allow us to pass those savings on.
You got all those. Good. So we can move into market structure and integration. CeFi, DeFi, and TradFi are no longer separate silos. They are converging. How do you see these rails interacting in practice, and what governance or infrastructure gaps still need to be closed before institutional scale truly happens? And I know we were talking about that behind the scenes. So Matt, let me give you the first one. So as a global broker-dealer and market maker, Cantor already runs deep repo and securities finance operations. How do you think about integrating digital asset credit into the existing infrastructure, and what's the hardest piece of the plumbing to modernize?
I think that's a lot of the reason why we structured our product the way it is structured, to look a lot like a traditional repo, because that's what we're comfortable with, right? That's what we do on a daily basis at billions of dollars at scale. I think what we've found, and I think a lot of other traditional financial institutions will find or are currently finding, is that the integration of on-chain to traditional books and records, audit history, trade ledgers, is quite a lift, and it requires meaningful resources and capital allocation up front, especially to support these businesses at scale. So I think there's kind of I don't know if that's the right word.
This is where you plug in the Cryptio solution.
Well, this is what we're discussing in the back, right? Like we've chosen the route of partnering rather than building a lot of the infrastructure necessary to ensure that Cantor can efficiently integrate our on-chain activities with our off-chain activities and kind of the more traditional business lines that we operate at scale and successfully to this point. But and oftentimes it can become a pretty complex tech stack and number of strategic partnerships that are required to ensure that the existing traditional rails work efficiently and within the kind of the proper regulatory confines that we need them to. And yes, quite frankly, but one of the things that we are not doing right now is offering 24/7 services to clients. I think the natural evolution is moving in that direction, but I don't think there's still a fair bit of heavy lifting for traditional financial institutions to get to that point.
That's why Coinbase is meeting halfway. Okay, Justin, you're next. Coinbase sits at the intersection of institutional credit and tokenization. How are you thinking about connecting prime custody with emerging tokenized markets on Base? And what guardrails need to be in place before institutions can safely hold tokenized collateral on your platform?
I'll start by, again, answering your sort of intro question, because I think it's actually a super interesting one. And it's,
like
it's a big animating sort of factor for us, the intersection between DeFi and CeFi. And because this really is what we've been focused on building on the institutional side at Coinbase for sort of many years, and centered on a Coinbase Prime platform. Just to sort of recap, we Coinbase Prime offers, the world's largest sort of crypto custodian. It's custodian for 8 out of 10 of U.S. listed BTC and ETH ETFs, offering military-grade security. We add on our Prime trading capabilities, connects to 8 trading venues. We facilitated about $1/3 trillion of crypto trading since it launched in 2021. And the financing capabilities, of which we've sort of touched on a little bit about here. So those are the kind of the core foundational capabilities to unlock most institutional investment journeys or uses of sort of crypto. But one of the unique things about Coinbase, really being a crypto native firm at heart, with a capital markets sort of business bolted on in some ways, is our sort of deep sort of on-chain expertise. Coinbase Prime also offers the Prime on-chain wallet, an insto-grade self-custodial wallet, fully integrated into the sort of Prime platform. So with all wrapped within the same insto-grade security, authentication, user access roles that are necessary, I think, for serious institutional players to sort of enter the space. And by this I mean, something as simple as the treasury or the operationals function can't initiate a transfer here. Only the portfolio manager, for example. And if it's above a certain dollar threshold, you require a video call for like face-to-face authentication and so on. All of these security controls, which are really necessary to operate at scale in the digital asset space. These wrap around our self-custodial wallet offering, just as they do our trading, custody, and financing operations. We also offer verified pools, which is a KYC'd, whitelisted sort of access way to access DeFi, so you can be sure who you're facing on the other side of it. And we think the combination of all these things, these 3 sort of foundational sort of primitives, and our on-chain forward capabilities in a single integrated platform, is really what unlocks the type of access that you were asking about.
Max, we have a few more minutes. Just want to get to 2 more. So Max, Galaxy engages with both CeFi and on-chain protocols, and your new on-chain Prime platform is designed to connect those 2 worlds, routing collateral and liquidity across venues like Aave, Morpho, and Camino. How does that model actually bridge CeFi and DeFi in practice, and what gaps still need to close before it scales?
I think the main purpose behind it is there's a number of institutions that cannot face DeFi, whether it's because they're not set up from an operational standpoint or regulatory. They just don't want to interact with any of the on-chain pools. And so what it allows for is for a traditional financial player to come directly to Galaxy. They see the rates that are on-chain, and we can do that back-to-back for them, create that white glove service, and really access the DeFi market to the masses, and that's sort of the plan behind it. Your question on what we can do in terms of getting this thing fully to scale, I think what we want to do is we want to get a bunch of these counterparties onboarded. It's going to take time to get them through the piping, and then understand kind of what's going on behind the scenes, and we're happy to kind of walk them through it. But I think that there's a decent number of players who would hear that, be super interested in it, and it's a matter of getting it off the ground.
Appreciate it. So I think we're actually up on time. So Dhruv, sorry for not being able to ask your. Everyone can come over to Dhruv after and ask him his last question. But appreciate everyone's time. Thank you. Thank you, everyone.
We can take 1 or 2 questions from the audience.
Okay.
Anyone have any questions? You can ask that final question, Cheryl.
Okay. So we won't neglect Dhruv. So your collaboration with Galaxy on a tokenized CLO aimed at bringing institutional credit fully on-chain. What's the idea behind it? Who's it for? How will it actually work in practice? And what needs to happen in regulation or infrastructure for that model to scale?
Yeah, and Max, feel free to add on from your perspective on it. But essentially, this is our CLO facility. We've tokenized it, and what that means is there's a digital representation of sort of a capital provider into that structure. And what it allows us to do, at least from our side, is have things like token-gated dashboards that provide real-time transparency into the loan book, the collateral, how everything performs, whereas in traditional markets, you're typically reporting on a lagging 1 month or more cadence. And so this brings visibility into a real-time basis, as well as now there's a digital representation. It unlocks maybe liquidity from secondary sources, as well as composability into DeFi. And that brings investment that was more 2 years illiquid or even more in duration now into a level where you have more capital pockets that can access it just given its new liquidity profile.
Yeah, and I think that there's a number of things that we're trying to do to continue to enhance it. We've reached out to a number of the rating agencies. We're going with a very vanilla structure to start. And then we want to introduce what we've created together. I think introducing that first layer allows them to get familiar with Bitcoin as collateral, and then we can start to expand. What we have done with the CLO is we found an on-chain provider, won't name names here, but they have a large amount of capital who are very interested in the structure. They come from structured finance backgrounds, and so that allows us to tap additional capital and really create the scale needed so that they can go from, I don't know, what are you, 150 million to $1 billion over the next couple of years.
Impressive.
Right, thank you very much. We'll be breaking for 15 minutes, but thank you to the panel here.